Hi everyone, and welcome! Today let's discuss something that may seem a bit counterintuitive, creating substantial wealth using real estate, not during a boom in the market, but when things are grinding to a halt. Many people panic in a recession, but for the savvy investor, that's where the greatest opportunities lie. It's not about betting on quick flips. It's a long-term, disciplined strategy focused on a property's intrinsic value and rock-solid cash flow. So if you're ready to learn how to not just survive, but actually thrive in a down market, you're in the right place. So why is real estate such a good wealth-building tool when other investments are faltering? It's simply because these four pillars are all working together. Number one, you've got cash flow. That's the consistent monthly income from rent. It's what pays your bills and gives you that operating stability when you need it most. Then there's appreciation. This is the natural growth of your property value over time. It's the long-term wealth creator that works in the background. The third pillar is leverage. This is the magic of utilizing other people's money, a bank loan, for instance, to control a large asset. You get to amplify your returns by paying a fraction of the overall price. And last but not least, the one that most people overlook, tax benefits. The government actually incentivizes real estate investing with such benefits as depreciation, which enables you to shelter a lot of your rental income from taxes, and favorable capital gains treatment when you sell. All four of these forces together give you a wealth creation engine that's tough to beat. Now, philosophy to practice, successful investing is a numbers game. You can't decide by intuition. You must speak the language of real estate finance, and that means understanding your key performance indicators, or KPIs. Think of them as the dashboard of your investment car. They give you everything regarding the health, risk, and potential of any property you're looking at. Two of the simplest numbers are net operating income, NOI, and cash flow. Your NOI is the amount of profit that the property is generating before you pay your mortgage. It is all your income minus your operating expenses, like taxes, insurance, and maintenance. This number is significant because it drives the property's overall value. Cash flow, on the other hand, is the bottom line that ends up in your bank account every month. It's what's left over after all expenses, including that mortgage payment. Positive cash flow is your security blanket. It's what allows you to weather vacancies or unexpected repairs without it impacting you personally. Up next is a measure called the capitalization rate, or cap rate for short. It is your go-to for a speedy risk assessment. Basically, it'll give you the estimated return on a property if you paid for it all in cash. The formula is simple. You take the annual net operating income and divide it by the property value. So if, for example, a $14 million property is pulling in $600,000 in NOI, you do the math. $600,000 divided by $14 million, and you arrive at a cap rate of approximately 4.3%. Here's how to think about it. The higher the cap rate, the riskier the investment, but it might also mean you're getting a great deal on a bargain-priced property. The key is to always compare similar properties. You know, apples and apples. Don't compare a brand new apartment complex in a nice area with a fixer-upper in an up-and-coming neighborhood. And watch the interest rates. When rates go up, cap rates will also go up, which can actually create some amazing buying opportunities for those with cash to deploy. If there's a single ratio you need to burn into your head, it's the debt service coverage ratio, or DSCR. This is your ultimate survival ratio, and lenders worry about it more than almost anything else. It tells you and them whether the property's income is sufficient to cover its mortgage payments. You calculate it by dividing your net operating income by your total annual debt service, your principal and interest payments. Let's break down what the numbers are telling you. A 1.0 DSCR is break-even. The rental income exactly covers the mortgage. Most lenders won't even touch that. They'll typically require at least 1.25x. But this is the pro-investor move, especially heading into a recession. You're going to want to be looking for a 1.5x DSCR or higher. Why? A 1.5 times DSCR is your property's ability to absorb a 33% reduction in income before it starts to lose money. That is your buffer. That is what helps you sleep at night in uncertain economic times. Plus, the higher the DSCR, the better the loan terms, the lower the interest rate, and the more leverage with lenders. It's a win-win. Now I would like to talk about leverage, which is truly a double-edged sword. The two most important ratios here are loan to value, or LTV, and debt to equity, or DE. Your LTV is the proportion of your loan amount to the property value. It's what gives you your equity cushion, how much of the property you actually own versus the bank. Debt to equity looks at all of your obligations as a percentage of your equity, giving you a broader picture of your financial leverage. Here's the key principle. During a boom market, high leverage can supercharge your returns. You put down little and you gain a lot. But during a downturn, the identical high leverage will boost your losses and can wipe out your equity cushion very, very rapidly. For a recession-proof portfolio, conservative leverage is not a suggestion. It's a foundation. You require a firm equity position to shield you from falling property prices. All right, now that the fundamentals are out of the way, let's talk about how you actually do this. Your choice of investment strategy will determine both how fast you build wealth and how much risk you're taking on. The spectrum goes from low-risk, passive income models to highly scalable, active methods where you're constantly rolling over your capital. The conventional strategy is buy and hold. That's where you purchase a good property, rent it, and then hold it for the long term, making money through gradual appreciation and that steady rental income. The advantages are clear. It's a lower risk profile, and it's fantastic tax treatment. The property is a capital asset, so when you ultimately sell, your gain is taxed at the lower long-term capital gain rate. And you also get to deduct depreciation each year, which gives you a great deal of shelter for your rental income from taxation. The big limitation, though, is scalability. You can only grow so big because your cash gets tied up in each property. To buy the next one, you have to save up another down payment from scratch, and that can really slow down your wealth creation. On the other end of the continuum, you have the high-velocity strategies. First, the fix and flip. You buy a distressed property, renovate it, and sell it at a profit within a short period of time. It can be lucrative, but requires a lot of capital and involves huge risks like renovation cost overruns and market timing. And understand that if you do this habitually, the IRS will likely classify you as a dealer, and your gains are treated as ordinary income, which is a much higher tax rate. Then there's wholesaling. You get a property under contract, and then you sell the contract to another buyer before you even close on it. It requires very little capital with minimal financial risk, but the catch is that the profit is generally much lower since you never actually take possession of the asset. What if I said there was a strategy that combined the best of both worlds? Well, there is one, and it's called the BRRRR method. It's the scalable wealth creation gold standard, in my opinion. It stands for buy, rehabilitate, rent, refinance, and repeat. Here's how it works. You start by buying a discounted, distressed property that needs work. Then you rehabilitate it, but you're strategic. You only make renovations that will really increase the appraised value. Then you rent it out to a qualified tenant, and you stabilize the income. Then you perform the magic step. You refinance it with a bank at its new, higher value. This cash-out refinance allows you to pull out most or even all of your original investment capital. And then you do it all over again by using that reclaimed cash to do it again on your next property. This is why BRRRR is so powerful. First of all, it's all about capital recycling. You're not waiting decades to access your value through a sale. You're taking that illiquid value and trading it for liquid, reusable cash via the tax-free refinance process. Second, you're creating what's called forced appreciation. You're not just waiting for the market to appreciate, you're making value through your rehab. And Bird, you get incredible tax optimization. Because you're going to rent and hold, it's an investment property, so you still get all those depreciation benefits while getting your initial capital returned to reuse immediately. It systematically removes the biggest problem with buy and hold, the slow appreciation. So with that mindset in place, let's take a look at the current economic climate. A lot of individuals hear the term recession and believe it's time to run for cover. But more advanced investors think differently. Recessions aren't necessarily periods of contraction so much as they are periods of forced repositioning. They're when market discipline returns. And that creates fantastic opportunities for those of us who are well positioned with capital and a solid strategy. There is a lot to learn from history, and the 2008 crisis is one such example. That boom in the 90s and 2000s was on unsteady ground. Low rates and loose credit that fed gigantic speculation. House prices doubled and more. But when the music stopped, the meltdown tore through the entire financial system, requiring huge government interventions to steady the ship. The key is that real estate goes in cycles, and again, policy decisions by the Federal Reserve are putting pressure on the marketplace. But this time, it's creating a different kind of opportunity. So what is the opportunity today? It is being called the 3 trillion maturity wall. Here's the problem. A huge wave of commercial real estate debt was taken on years ago when interest rates were at historical lows. That debt is now coming due and will have to be refinanced at much higher rates today. We're talking 5% to 14% or more. Many of those properties simply won't qualify for the new, tougher DSCR standards with that big debt payment. That's going to trigger a wave of asset sales. And that's the opportunity for us. That creates a predictable supply of distressed properties that can be bought at deep discounts. And because the foreclosure process takes 1 to 2 years, this is not a crash, but a slow-motion distress play that patient, prepared investors can capitalize on. Now, you don't just go out and buy any distressed asset. You need to focus on defensive, recession-proof asset classes. These are necessity-based asset classes, not discretionary. Number 1 is multifamily housing. Everybody always needs a place to live. In fact, when credit gets tight and people can't get mortgages, rentals actually see an increase in demand. Self-storage is another surprisingly resilient sector. It's actually counter-cyclical, in fact. When there's a downturn, people downsize, move in with family, or relocate for a job, and that generates demand for storage. And finally, industrial property, like warehouses and logistics centers, remains strong, thanks to the long-term structural trend toward e-commerce and reshoring of manufacturing. Conversely, some sectors are much more vulnerable, and that's where you're seeing the deepest discounts. Office space is facing a perfect storm of cyclical, recessionary pressures and the structural shift to working from home. Non-essential retail is also very vulnerable as consumer spending slows down. These industries facing both cyclical and structural woes are where you'll see the most pronounced price corrections. Now, a quick exception. Well-located, open-air retail centers with a diverse lineup of necessity tenants can still remain stable. But by and large, the best opportunities for deep discounts will be in these harder-hit sectors. So how do you go about acquiring these distressed assets? 2 main ways. First, foreclosure auctions. This is where the property is being sold by the lenders after they've repossessed it. Beware here. Lenders have a huge advantage as they can credit bid, meaning they can bid using the debt itself, which typically means you'll need to come with plenty of cash. An often better option for the BRRRR investor is a short sale. This is when the lender will accept a purchase price that is less than the outstanding mortgage balance, just to avoid the foreclosure process. The huge advantage of a short sale is that you usually do get due diligence. You can appraise and inspect before closing. For a BRRRR strategy, where your margin is so sensitive to renovation cost, this right to inspect is a game changer. It de-risks the most uncertain part of the process massively. As we proceed to more sophisticated strategies, keep in mind that recession investing requires hypervigilance in risk management. 2 of the most important areas are your reserve fund and your relationship with tenants. You must have a solid reserve fund. Or real estate is not liquid, so when something goes wrong, you must have cash on hand. This fund must be 6 to 12 months of all operating expenses plus your mortgage payments. This is your financial fortress for surviving unexpected vacancies, major repairs, or market slumps. Second, Smartly manage your tenant relationships. Communication is key in a recession. Providing a small, short-term concession in rent is sometimes cheaper than a vacancy and turnover. But you have to model this carefully, as every dollar you drop the rent reduces your NOI and your all-important DSCR. It's a balancing act. As bank loans have become so expensive, you need to know about alternative financing. Seller financing is a great option, where the seller becomes the bank. This is great for flexibility and can be a lifesaver if you are unable to secure a conventional mortgage. Mezzanine debt is a costly short-term loan that bridges a gap in funding. Warning: usurious rates can be as much as 30% in some cases. So these should only be taken on projects with astronomical projected returns that can readily absorb that cost. And finally, you have LP-GP structures, where you bring in money from other investors. You may be the general partner or GP who manages the deal, and limited partners or LPs provide the passive capital. This is how you take on larger projects when debt by itself will not be sufficient. So let's recap everything with your recession wealth building blueprint. Number 1, attain financial discipline. Shoot for that 1.5x DSCR from day one and maintain that 6 to 12 month reserve fund. This is non-negotiable for resiliency. Number 2, execute the BRRRR strategy. Forced appreciation and capital recycling are your vehicle for scalable growth. Number 3, leverage structural distress. Place your core stability in defensive assets like multifamily, but be ready to capture deeper discounts in asset classes like office that are experiencing structural transformation. And number 4, navigate capital constraints creatively. Utilize alternative financing like seller financing strategically, but always ensure that your project returns can cover the cost of that capital. Keep in mind, the objective isn't to simply ride out a recession. The objective is to leverage the market contraction as a force for accelerated, sustainable wealth creation. It's a matter of discipline, being ready, and taking action on a tested plan. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.